How's it going?
Hi. Oh. And we are sponsored officially. Yay. Good morning, everybody. Welcome to Wake Up with YPN. Happy Monday. We would like to welcome Pete Johnson here from GreenState to talk a little bit about the current market, rising interest rates, and everything lending. Welcome, Pete.
Hey there, how's it going?
Great, great. How are you?
Not too bad, not too bad. Thanks for having me.
So do you just want to introduce yourself, kind of talk a little bit about who you are, your experience, all that kind of good stuff?
Yeah, absolutely. I'm a mortgage loan officer with GreenState. Been with GreenState's lending team here for it's about 11 years now. I got to think about that after a while, but I've been in the mortgage industry for about 20 years as a mortgage loan officer. Started out, kind of done a little bit of everything. I've been with small brokerages, I've been with great big old banks, and then finally transitioned over to GreenState. What was it at the time? University of Iowa Community Credit Union. Finally kind of moved over here. I've always kind of wanted to work in the credit union kind of sphere of things, and finally got a chance to do that back in 2000. I guess it was 2010, 11. Gosh, I have a hard time thinking about it. That's what happens when you get older. But anyway, yeah. So I've been here for quite a while, and yeah, been loving it. Working in home lending for quite some time. So
wonderful. So can you tell us a little bit about what the market's doing right now? I know that everybody, has heard so much about interest rates. So
yeah. The biggest thing that's been happening kind of is two things really. Interest rates kind of going up, pretty rapidly, and have actually kind of leveled out finally here at about 4.875 to 5% on the 30-year fixed rate. But they've kind of come up from our COVID lows, when rates were kind of in the twos and mid twos and high twos and stuff like that, up to this kind of higher rate. And then also we've had prices go up. There's a severe shortage. If you watch the national news, at any given point in time, you kind of hear about, the shortage of housing. And that's been a thing that's really been going on for the last 4 or 5 years. What people don't really kind of think about is that this isn't something that just started happening this year. This has really been a trend kind of long term really for the last 4 or 5 years. And it's kind of come to a head now, and obviously exacerbated by, COVID, kind of sped that up and kind of made it a little bit extreme. So you've got kind of what I call a 1-2 punch. You've got higher interest rates, which are always kind of a challenge. And then you've got high prices, on homes, which are also a little bit of a challenge. Some of that appears to be leveling out right now. So we're kind of hoping that it appears that rates have kind of leveled out a little bit. It stopped their kind of rapid climb. And, hopefully we'll start to see prices, so as supply chains start to keep up, the Fed's, getting really aggressive with inflation. That's really what's causing a lot of these problems. We're starting to see that kind of mellow out a little bit. And so hopefully that'll continue, and, maybe we can get back to kind of some kind of a normal where we're not in this, super excited state, so to speak.
Yeah, absolutely. So, I mean, other than just with kind of the market being where it's at, with everything changing as rapidly as it has been, what are some of, sorry, my words are failing me this morning, but what are some other causes of interest rate changes, just other than, like you were talking about with the shortage and kind of how the market has been post-COVID?
Yeah, it's kind of a couple things. I mean, the price increases are obviously because of, shortage of home price. And anytime you have a shortage of supply and a high demand, you still have a lot of buyers out there, a lot of the millennials that are coming into the market right now. Anytime you have a short supply and a huge demand, that's what's causing prices to rise. Obviously, that's pretty obvious. And with rates, I won't get too much into the weeds with interest rates, but a large part of it has to do with inflation. We've kind of been at super artificially low interest rates for a really long time. The government, obviously during COVID, worked really aggressively to drop rates basically to zero. The Fed rate that you always hear about was really low, and they've started to increase that. We started to feel the effects of that to some degree. The Fed rate, it's kind of a little bit of there's a lot of perceptions about what the Fed rate does and how it impacts mortgage interest rates. The Fed rate indirectly affects mortgage interest rates, but really it's bonds, specifically the 10-year Treasury note. as the price of bonds goes up, rates goes down. They move inversely to each other. Likewise, when the price goes down on bonds, as investors, leave the bond market, rates go up. And that's what we've kind of been experiencing here lately is kind of hyperinflation in rates. And so rates have kind of really started to get back to where they were going anyway. This again was kind of a trend that was happening back in 2018, 2019. We had rates that were pushing the high fours, low fives back in 2019, just very briefly, before they plummeted, due to COVID. So what we're doing now is kind of slingshotting back, and unfortunately it's happening kind of rapidly. Slingshotting back to where we were, kind of in what we would have considered a normal market. It's really not normal to have 2.5% interest rates. That's something I've never seen in my career. I don't think anybody really ever has. And so that's not something that's very natural. And so we're kind of moving back to where rates were at, back in 2019. When I first got in the business it was 2003 or just before that, rates were 7%. And that was considered an okay rate. And I can remember when rates dropped to 5%, people lost their minds and we refinanced everybody. They thought that was amazing, and then rates would drop into the mid fours and we'd refinance again. We had several refinance booms over and over. So part of it, you got to kind of put in perspective, that these rates are going up, but it's not the end of the world. This is kind of not something that's completely, unnatural. It's not something really that's even out of the ordinary. These rates are still historically really low, so, the media, always has the narrative, well, these crazy rates are so high and it's making things really unaffordable. And to some degree that's true, but it's also not something that we really haven't experienced before. I think what's new though is the combination of prices going up and the rates. It's that 1-2 punch that really makes it difficult for buyers, especially new buyers coming into the market. They're having to battle the, obviously higher rates, higher monthly payments, but also these higher prices. And it's the combination of the two things that make it really difficult. Plus you throw on top of that the challenges of just finding a home. As a first-time home buyer, just being able to get into the market and compete with somebody that's, maybe a second or third-time home buyer that can maybe make an offer in cash. They're selling their house very quickly at a premium and then buying a home in cash. You're having to compete with that when you can't buy a home in cash. Yeah. Those are the things that make it really challenging. I think that it's something a little bit different that we haven't really had to contend with in a really long time. So yeah.
With this going on, have you seen the demand for pre-approvals kind of increasing, decreasing, staying the same?
Yeah, as of late, it's been obviously decreasing. I think really just now, we're starting to feel some of the effect of the Fed increases. The Fed's obviously trying to stamp out inflation, which has been kind of running away here. And that's really starting to work now, which is probably a good thing in the long run. It's a bad thing in the short run. And things have really slowed down. Part of that is seasonality. I mean, we had a really good spring. We've obviously got a ton of closings happening in June and July still yet. And I think that'll continue as, a lot of the people that found homes in March, April, May really start to close in June, July, and August. So part of that is just seasonality. We're still going to be really busy through those months. Like we normally are. Where we're going to feel a slowdown, I think, is probably in, September, October, November, December, probably the first quarter of next year. That's when things will probably slow up a little bit. And we're starting to feel that quite a bit. The pre-approvals have really started to drop. Again, part of that is just the season, the people that were trying to beat their leases to get into a home, either signed a lease and they're not in the market anymore, at least this year, or, they found a home and they're closing in June or July. But the other part of it is I think a lot of people, some people, a certain portion of the market probably gave up, just couldn't find a house, couldn't win in the market, so to speak. But a few people probably got priced out as well, the price of the home in combination with the rates. And obviously you've got the media out there with kind of a narrative that, you've got no chance, right? We've been kind of trying to combat that a little bit. You do still have a chance. It's just that it takes a little bit of education, a little bit of kind of preparation to be successful. But yeah, no, there's definitely been a slowdown in the number of pre-approvals have really dropped. I'd say a little bit more than normal here in the last 2 to 3 weeks, especially. We've seen that for sure.
Mm-hmm. So with, seeing all of these changing rates, how has that affected the amount that a borrower can be approved for?
Yeah, it kind of depends, in the higher end of the market. So when you get into the, if you're borrowing, say, 4, 5, 600,000, 700,000, those rate changes are pretty, are pretty severe. I mean, the rate change and the cost of the home, obviously, pretty severe. I was just looking at a $300,000 loan. I ran some numbers on one today. If we pre-approved you at like a 3 or 3.5% interest rate, a few months back in January or February, and you're just finding a house now you're finding your rate is maybe 4.875, 4.5 to 5, let's call it. On a $300,000 loan, for example, that's about a $263 a month difference, anywhere from $260 to maybe $300 a month. So that's a pretty good jump. If somebody was kind of on the bubble, they were really having a hard time finding anything. They wanted to be maybe at a $250,000 loan amount. That's really where they were comfortable. And now they're finding themselves at a $300,000 loan amount plus the interest rate is higher. That's making it tough for sure. That's making it a little bit tougher to qualify, a little bit more of a squeeze. If on the other hand you had, more disposable income, you wanted to be at that level, but you could afford higher. It's painful, right? Nobody wants to pay more on their mortgage, but they can swing it. And a lot of people, depending on your market, in this market, Iowa City area, Coralville, North Liberty, that's where I work. I'm downtown Iowa City here. I work with a lot of physicians. A lot of people in the Iowa City market, at least especially, kind of have to find a home and buy. They're moving here from out of state. They have to find a house. And so it may not make any difference. It's a little bit painful, but they still got to buy, right? So we're still signing purchase agreements. We're still getting people in. On the lower end, though, on the first-time home buyer side of things, that's where it gets a little trickier. First-time home buyers, younger first-time home buyers, and also retirees that are on fixed income. I'd probably add into that group too, where a $300 swing in payment is a big deal, right? So if you're already kind of on the bubble, a $300 swing in monthly payment over what you were expecting, when you got pre-approved earlier in the year, is definitely going to make it a little bit more difficult. And I would say that's probably the category of people that are falling out more so than not. I would add to that maybe the new construction crowd too. The new construction's been hit the hardest probably with price increases. If you've had any clients that are doing new construction right now and you've gotten bids back, that those bids are coming in maybe 10, 20% higher than what they expected. And especially in the higher end, it's that combination of things. It's the higher prices of the home, substantially higher than they expected, higher loan amounts, and then also higher interest rates on top of that. That's causing some of my new construction people to kind of reevaluate. We've had quite a bit of fallout in new construction as people have said, you know what, I'm just going to wait till next year or the year after, see if prices come down and try again, or maybe they find an existing home cheaper that they can buy. So so those are a lot of the things that we've kind of been contending with. So.
Yeah. So what advice would you have for realtors who are working with their clients in this market?
Yeah, I would say is try to stay positive. There's a lot of negativity out there. There's a lot of, it's impossible to find a home or you won't be able to afford it. The rates are so high. And I'd say most of your clients don't really know. They watch the news, they read things online. They don't really know the reality, and every market is different. Most of the news stories that you hear are geared towards the national market. We're pretty blessed here in Eastern Iowa, I think, with a pretty strong market that's fairly recession resistant. It's not completely recession resistant, but it's definitely more resilient. And we tend to have pretty low rates, fees. Like we're going to be a little bit lower than the rest of the country when it comes to rates and fees. So we've got that going for us. So it's not impossible, but on the flip side, I think you need to be honest, with your buyers. As they're coming in, in terms of what they're dealing with. When I'm talking to people, I'm always kind of prepping them. If you refer a client over to me, I'm kind of prepping them with some of the challenges that they're going to have, not to bum them out and, cause them to give up, but just say, hey, listen, here's what's happening. We need to be prepared for rates. Here's where rates could be, in the next few months. They might be higher. So we might want to consider, what your payment is at 5.5%. As opposed to 5 or 4.5, right? Make sure that you're still good with that so that things aren't a surprise when they actually get a purchase agreement. Letting them know that, they're going to maybe be competing with 5 or 6 buyers because there's so many buyers in the market. they may have to make an offer that's a little bit over the asking price, or they may have to, they may not be able to get everything that they want, in a remedy request or something like that. So, I mean, I think those are the things you can do to prep people so that when they do get into an agreement, they're not surprised, shocked, and end up having a bad experience as a result.
Yeah, absolutely. So in terms of helping prepare some of our buyers who are getting financing through GreenState, what are your locks look like right now for?
Yeah, so usually we're locking in interest rates. We've got a couple of really good programs. We've got our in-house loans, kind of two categories of loans. We do standard conventional fixed rate loans. Those are the 30-year, 20 or 15-year fixed rate stuff that we do. Those rate locks, those are the interest rates that are really sensitive. So when you hear about rates going up or down on the internet or on TV, that's what they're talking about. Those rates are market-based. It's kind of like the cost of milk, right? It goes up every month. It's probably different, right? So every week in this case, really every day, they can change. And generally, we're locking in an interest rate within 60 days. So we need to have two pieces of information to lock an interest rate. We've got to have your close date and your address. We need those two things. We can't really just lock a rate preemptively, indefinitely. There are a few gimmicky programs out there that will allow you to do what's called lock and shop. But most of them come with higher rates and fees. There's usually a catch involved when you do it. And so for most people, they're going to be locking, say, 60 days out, maybe 90 days out or less. The farther out you lock, the higher your interest rate generally goes. So you're paying a premium for that because banks know that they're going to be subject to rate changes too. They've got risk involved as well, and they're certainly pricing that in. And so generally speaking, the farthest out you can usually lock on a secondary market or a conventional fixed rate loan is typically 60 to 90 days, okay? Usually 60 days or less without paying an additional fee to do so, right? On our in-house stuff, though, it's fairly flexible. You get a 90-day rate lock for free. So these are generally ARM loans, the 10-year, 7-year, 5-year adjustable rates that are spread out over 30 years, like a 30-year fixed rate is, but the interest rate itself is only locked in for 5, 7, or 10 years, depending on how long you plan to be there. Those rates generally start at 90-day rate locks regardless, and there's no additional fee to do that. So that's kind of nice. And we've really used our in-house rates, especially the 10-year ARM recently, because that interest rate is lower. The interest rates are lower on the ARM loans, which might help offset some of the payments, shock that you're experiencing when you do a conventional fixed rate. But it also allows you to protect that rate longer. We've got a new construction or long-term rate lock on our purchase deals as well. They'll actually allow you to go out as far as 10 months with a float down option, which basically means that if the rate drops, we'll give you the lower rate for free, okay? Not likely to drop in that time frame is my guess, but nonetheless, it exists just in case it does. Maybe you have to lock in on that extended rate lock now at a higher rate. The rate's a little bit higher on that program, but still pretty good. But that's great if you're doing new construction, because those new construction projects typically take 6 to 9 months, maybe 10 months to finish. That allows you to lock in that rate so you can say, hey, my worst case rate, is maybe 4.5 or 4.75. That's my worst case. If rates go to 6% or something, you're always going to be under 5 at least, which is pretty good. So that gives you some options to try to hedge that risk a little bit.
And that's great peace of mind for people who are worried about making sure that they're getting the best rate possible. Mm-hmm. So that's
right.
Great. Yeah. Okay. Yes, we have a question. Why is working with a local lender more preferable than online or out-of-state lenders? That's a great question.
Yeah. So out-of-state lenders, depending on who you're working with, and I don't want to necessarily bash them, but you're usually working with somebody out of the market. I do a lot of out-of-state loans as well. GreenState can actually do out-of-state loans. The problem that you run into is that you're just not as familiar with the market, the title agents that they use. The people that are around in case something goes wrong, right? If somebody has 20% down, 800 credit score, and they're about the easiest, buyer you've ever worked with in your entire life, it's probably fine to go with an out-of-state lender. But each company's culture is different. And when you get into some of the larger banks, because a lot of the out-of-state lenders tend to be the bigger banks. You got the U.S. banks, the Wells Fargos, the Chases of the world. And with big banks comes big cost, typically speaking. So you usually have higher overhead. And it's not that they're trying to rip you off. I used to work for Wells Fargo, for example. I worked for Bank of America as well. It's just that their costs are higher. Their overhead is higher. the fees that you typically charge in a market can be higher just because that's the way it is. That's how that market operates. That's what it costs to function in those markets. That's completely different in a smaller market like Iowa. I'd say in Eastern Iowa, really anywhere in Iowa. We're very lucky in that we're a very low cost state. We really don't have a lot of fees. It's about $1,800, $1,900 to close a loan, everything included. In Iowa, we don't generally charge a lot of points and fees, for rates and stuff like that, whereas they do in other markets. So when I see some of the online lenders, I can see closing costs when I see these sheets coming over, the costs are so much higher that it really makes sense to kind of shop out a local lender. You'll have, I've seen closing costs on a deal that I can close for $1,900. I've seen closing costs as high as $10,000. So there can be a huge difference. So there's that, just saving your client money. But there's also the local aspect of, if you're working with a local lender here, whether it's GreenState or one of the other banks here locally in town, we have a stake in it. We live here. We have to see you at the grocery store, out at the Arts Fest or wherever. So we've got a reputation to uphold. It's important to us that your deal closes, that it closes on time, and especially if something goes wrong, if there's maybe not the most perfect buyer. Maybe they've got some credit dings or something, something that's a little bit off in their credit profile that makes their deal a little bit more challenging. Maybe the property type, you're dealing with a rural property or something like that. On the in-house side of things, when we're keeping loans here at GreenState, there's other banks that can do that as well. We have the ability to pivot. Maybe this deal won't work as a conventional fixed rate loan, which is more strict. The guidelines are more strict, but we're able to pivot and take it in-house because something unexpected happens. If you're working with like a U.S. Bank, a Wells Fargo, a Chase, a Quicken Loans especially, they aren't going to be able to do that. They're stuck with what they have, which is the standard secondary market conventional playbook. They aren't as committed either, so I've had some people get the experience where they're like, well, sorry, we couldn't get it done. There's nothing we can do for you. Or worse yet, they kind of drag it out, and it takes months and months and months for them to tell you no. Which wastes a lot of time, right? You could have got your buyer to a local lender and you could have got them, in and got the process started. Even though the closing might be delayed, at least it's still happening, right? And so that's why it's really important. And not to say that there aren't good secondary market, out-of-state lenders out there that'll do a good job and get the deal done. There are certainly. It just tends to be a little bit safer. It takes some of the risk out of it, in my view. Even when I'm doing loans out of state, I always get a little bit nervous because I'm like, I don't know what the market's like in Milwaukee, right? So it's a lot more work, and we'll do everything we can to get it done, but it's a lot more work. It's harder to kind of figure out, what are the, who are the people, who are the players involved here? How does this market work? And we figure it out, but it's kind of the quality of the loan officer that you're dealing with. You might be dealing with somebody that's got 20 years of experience, or you might be dealing with a call center person that just started yesterday that doesn't care, whether your deal closes or not. So it's kind of a wild card. So.
Oh yeah, absolutely. And just as an agent representing buyers, it's so much easier to work with a local lender when you don't have to rely on an email or a phone call. If I have a question, you can always just stop by the local branch, talk to them in person, get it all squared away.
Right. You might be able to get a hold of somebody on a weekend, those kinds of things. That's stuff that's going to be really hard to do when you're dealing with a call center person at Quicken Loans or Bank of America, right?
Yeah. So what advice would you have for prospective home buyers in this market? Are there any other tactics to strengthen the buying power when it comes to the lending side of things?
Yeah, I think just, the big thing is just acting fast. I get a lot of people that, they aren't really thinking about the loan until they like find a house, right? They're like, I have a lot of people call me and they're like, well, I'll get back to you like once we start getting serious about looking. And then sure enough, 4:00 on Friday afternoon, the next week, they found the perfect house.
Yeah.
And they need to get pre-approved immediately, which we're happy to take care of people. But, I try to impress on people. It is really, really important now, as you guys probably know, that you get in, you get very serious, you get your formal pre-approval, even if you don't have anything that you think you're going to buy, even if you don't think you're going to buy for another year, get in there, let's get in and get credit pulled, get a pre-approval. Let's figure out all landmines. Let's try to figure out what's wrong. If there's anything wrong, let's get those things resolved. Let's figure out, if you need to maybe save a little bit more money or need to fix something on your credit, let's figure all that out right now. Let's talk about payments. Let's make sure that you know what range you're looking at, so you're not making an offer and then finding out that the payment is, $300 a month higher than you can afford. All that stuff wastes a lot of time and can cost you your deal, especially when things are moving so fast, when things are so competitive. It's super, super important that you have that, and then just kind of educating yourself, getting with your agent. I usually tell people that if you haven't found a realtor yet, I will get you with one, because you need to have a realtor in this market. It's hard to go around and just make random offers, on houses and talk to for sale by owners and stuff like that when you don't really know what the market's like. You don't really know what's out there. And I say most of this stuff is being sold half the time, I feel like, before it even hits the market, or if it does hit the market, it's sold within minutes. It's just really tough if you're not prepared and really ready to go. So.
Yeah, absolutely. And hey, we're free to buyers. So
That's right. Yeah, that's right.
So knowledge is power in this market when it comes to the lending process, knowing what your own financial situation looks like. Pete, thank you so much for being here. If anybody has any questions, even after this is done airing, please pop them in the comments below, and we will make sure to get all of those questions answered for you. Is there anything else that you can think of that we haven't covered already?
No, I think that's great. If you have any questions, I'm always happy to help too. I do a lot of new realtor training and stuff like that. So if you're new, you want to grab lunch or you want to swing by my office, set a time to chat and kind of walk through. I do that all the time for people. I kind of like doing it because it helps me too. When you know more about the lending side of it, how to communicate with lenders, what to put in your purchase agreements. Feel free to email me. My email is just my name, Pete Johnson @greenstate.org. And can walk you through some of those questions. But feel free to call me, email me anytime.
Wonderful. Thank you so much. We truly appreciate you being on this morning. And have a happy Monday. Great rest of your week.
You too. Yep. Thanks for the opportunity. Appreciate it, guys.